Hi guys, welcome back to the Joyful Investor channel. Previously, we have done a beginner's guide series on call options and put options to share what they are and how they work so that you can have a basic understanding of options. The next question that many investors have is, how then can they use options to complement their stock investments? Well, there are certainly many ways in which we can use options as a stock investor, and we're going to share with you one way to do so in today's video. Hit the like and subscribe button and let's proceed. Let us first start off from the perspective of a stock investor. Now, as a stock investor, we want to make good investments. So our job as a stock investor is number one, to find a good business that is financially sound to invest in. And number two, to be able to invest in that stock at a good price, because a good investment is not just only about investing in the right stock, but also paying a good price for it. Just like when I do my online shopping, I'll be sure to get good quality items. But I will also want to look out for discounts so that I can get the same good quality product but at a bargain prices. But the problem is good stocks are often traded at high prices because there is usually demand for these stocks, which drives up the share price. Especially growth stocks like tech stocks, they are usually trading at a premium. So here comes the problem. There will be times where a stock investor may find that even though he wants to invest in a particular stock right now, but he can't do so at the moment because the stock price is pushed up too high, and that will leave him to search for other buying opportunities from other stock counters or to wait for the stock price of that stock to retrace based on technical analysis. And this is where options can come into play. If we know how to incorporate options, it may open up another alternative for us. Here's how. Take for example, you want to invest in McDonald's stock right now, but you find the current stock price too high. So instead of doing nothing while waiting for the stock price to come down, you can choose to sell a put option at a strike price in which you are willing to buy the McDonald's stocks at. If this put option is assigned, you get to buy McDonald's stocks at the share price which you are willing to pay. On the other hand, if the put option is not assigned, you still earn the put option premium, which is better off than doing nothing and purely waiting for the stock price to come down. What this means is that either you get the shares at a price that you desire, or you get paid to wait for it even though the price doesn't come down. That's just a gist. So let's now do a more thorough analysis of the possible outcomes that may happen. So suppose today is 6th December 2022. The current share price of MCD stock is $272. There are three possible actions that you may take. Action 1 is to sell a put option for McDonald's with a strike price of $250 and expiration date of 20 Jan 2023. The put option premium that you will receive in this case is about $140. Action 2 is to do nothing and wait for the share price to drop to $250 before you buy. And action 3 is that even though the price is high now and it is against my investing principles, I will still just buy the MCD shares now at $272. There are three possible scenarios that may happen by the expiration date. Scenario 1 is that the share price of MCD drops below the strike price of $250, say to $240. If you have taken action 1, then the put option will be assigned to you in this scenario. As a seller of the put option, you now have the obligation to buy 100 shares of MCD stock at the strike price of $250. The good thing is that since you have received a put option premium of $140, the net cost for the 100 shares will be slightly lower. Comparing Action 1 and Action 2, you'll be slightly better off under Action 1 due to this additional option premium that you receive. Under Action 3, if we had bought McDonald's shares directly at $272 back then, instead of selling this put option, then the capital loss on this investment right now would have been larger. Scenario 2 is that the share price of MCD drops to around the strike price of $250. Under this scenario, depending on the automatic options exercise instructions of the brokerage, the put option may expire or be assigned. Regardless, you can still get to own the McDonald's shares at the current market price, whether is it through the put option assignment or through buying from the stock market directly. And you still get to receive the put option premium. Hence, the net cost for this 100 shares will be slightly lower than the current market price. Comparing action 1 and 2, you'll be slightly better off under action 1 due to the additional option premium that you receive. And in comparison, if we have taken action 3 to buy the McDonald's shares at $272 back then on 6th December, instead of selling this put option, the capital loss on this investment right now would have been about 2.2k. Scenario 3 is that the share price of MCD shares increases to say $290. The put option will not be assigned to you, but you still get to keep the put option premium of $140. And in this case, you will miss out on the capital gain on the underlying MCD shares that you will enjoy under Action 3, but you are still better off compared to Action 2. So though you miss out on the capital gain, in actual fact, you are not losing any money here. So let's do a summary. In a nutshell, if we compare Action 1, which is to sell a put option now, versus Action 2, which is to do nothing and wait for the share price to drop to the desired level, we are generally better off by selling the put option. This is because the put option premium gives us additional profits under all three scenarios. And if we compare Action 1 against Action 3, which is to buy the MCD shares now, then selling a put option may produce a better outcome on an overall basis. Even though under the third scenario, we'll miss out on the capital gains, but we still get the profit from the option premium, and we do not lose any money or incur capital loss. Whereas for Action 3, under the first two scenarios, we will suffer greater capital losses. So as you can see from the examples that we went through, that is one way in which we can use put options to complement our stock investments. Instead of just waiting for the share price to fall to your desired level, you can earn some additional income through selling put options, and you may get to own the shares at the strike price that you selected. Though options are often associated with trading, there are ways in which we can use it to our advantage from a stock investor point of view, as option is a versatile instrument. But do take note that there are some considerations that you need to make before adopting this strategy. The first one is that you must be willing to hold 100 shares of the particular stock. Each option contract covers 100 shares of the underlying stock. Hence, there needs to be conviction in the fundamentals of the business before you're comfortable with buying the 100 shares. And this brings me to the second point, which is that you should have the capital to buy the 100 shares in the event that this put option is assigned. Ideally, we do not want to resort to borrowing money to raise funds to buy the 100 shares. And lastly, we need to understand that by selling the put option, it does not make us immune to any capital loss on the underlying stock when share price falls. As we have seen under the examples shown, when share price falls, we would still incur capital loss, although the option premium will help to cushion the impact slightly. So I hope through this video, you learn how you can make a practical application of options as a stock investor. If you enjoyed the video, hit the like and subscribe button for more videos to come. Do also subscribe to our Telegram channel to stay updated with our latest investing insights. See you in the next video.